Palantir is one of the best performing AI stocks in the market this year. It's already up 130% in 2025. Investors are looking forward to 2026 and asking me, where do I think this share price will be by the end of next year? I'll answer that question in this video, looking at a few estimates and making a few assumptions, putting it all together in a scenario analysis and making my price prediction. Of course, I'll share with you precisely where I'm getting all the information and the numbers I'm using, so you can determine yourself if my number and my estimate is accurate, too pessimistic, or too optimistic. So speaking of estimates, it's a good time to thank the sponsor of this video, Fiscal.ai. They are where I retrieve a lot of my financial information, and there's a link in the description. If you're interested, you'll get a 15% discount for using my link. They aggregate a lot of financial information. They saved me a tremendous amount of time in conducting financial analysis. So one of the figures I'm going to need to make this price prediction is the analyst estimate for where Palantir's earnings per share will be in 2027. And that figure is here at $1.40 per share in EPS in 2027 for Palantir. Now, I also need Palantir's forward price to earnings ratio. And I also retrieved that number from Fiscal.ai, and they're trading at a forward PE of 189. It's down from over 250 earlier in the year. Remember, I was talking about how unsustainable that forward PE valuation was. That was more than 10x the valuation of the average stock in the S&P 500. And unsurprisingly, that valuation has come down to 189, something I predict will continue throughout 2026. So now that we have the estimates that we need, we can go ahead and jump into the scenario analysis. So I'm going to keep Palantir's 2027 earnings per share constant at $1.40, and I'm going to look at 4 different scenarios with the forward PE valuation compressing. And if it stays at 189 and the EPS remains on track to hit $1.40, then the share price could rise to $265 by the end of next year. However, I see this as the least likely of the 4 scenarios I've calculated. More likely, I think, is that the forward PE multiple continues to compress, and if it declines to 150, then the stock price will rise, but to $210 per share. If the forward PE declines to 125, then the stock price will be relatively flat at $175 per share. If the forward PE declines to 100, then the share price could actually decline to $140 per share. Now, just because these are the 4 scenarios I calculated doesn't mean these are the only scenarios possible. These are just the 4 most likely scenarios I envision for Palantir next year. Some of the bullish sentiments for Palantir next year will be the company's continued excellent revenue growth and increasing in its backlog and expansion with enterprise customers, which Palantir has done an excellent job achieving. This business deserves a premium valuation because it is a premium business. Revenue growth is accelerating, profit margins are expanding, cash flow from operations is excellent, the balance sheet is pristine, it's in an excellent business, and it has a competitive advantage. Second place is so far behind, so Palantir will likely persist in its excellent performance. No question about that. However, the valuation, I believe, more than accounts for those excellent prospects. So I'm forecasting a continued decrease in the forward PE multiple. And where do I see the stock price ending next year? Well, as you know, I provide a range estimate and not just a point estimate. And I think the stock price falls somewhere between $175 and $200 per share for 2026. There's still some upside available for Palantir stock, but I think the risk versus reward is unattractive because I see there being significantly more downside. So far, Palantir over the previous, I want to say 6 to 12 quarters has demonstrated almost flawless perfection in their performance. And if there should be any kind of hiccup or any kind of blemish on their quarterly financial results or their outlook, then the share price could experience a huge decrease. Whereas if they continue to demonstrate this kind of excellent performance, it doesn't really have the impact of lifting the stock because it's already trading at such nosebleed valuations, as you noticed from the company's most recently completed quarterly performance. When it reported earnings, they were excellent, phenomenal, flawless. But the stock price actually declined following that performance. It's because so much of its premium prospects are already priced into the valuation that there isn't very much the company can do to lift the share price much higher unless they exceed these expectations by that much more, right? They reported 60%, roughly 60% revenue growth. They would have to report 80 or 100% revenue growth to create this big upside, which I don't think they can do because they're already at such large scale and given the difficulty in rolling out their technology to a broader customer base. So that's my viewpoint. I'm curious to hear your viewpoint in the comments below. Hey, thanks for watching. I truly respect every viewer who takes the time to seek qualified financial analysis. Unfortunately, there are a lot of unqualified voices online giving unsubstantiated stock advice. My goal is to provide research that's grounded in data and professional training, not just what's popular. For those new here, I hold a master's degree in financial economics. I'm a CFA charter holder, an author, an adjunct professor of finance and economics. I've spent nearly a decade researching stocks professionally, and I'm here to help you make informed investing decisions. If you found value in this analysis, make sure to subscribe and consider joining the channel as a member for early access and in-depth members-only content.